It's always a good idea when talking industry issues to bring the client into the conversation. Today we've got 20 minutes to give a quick overview, and so we're not going to be able to dive into the kind of structured insight that you need if you're going to be putting your customer strategy together. To do that kind of thing you need a quantitative study, a segmentation study, and yeah, I've got one of those, and if you're interested, very happy to take you up and share that with you. Today's more about providing a general overview, a bit of a map of where the main landscape features are. We're going to have a look at where customers' wealth intentions and behaviours have been since the GFC, and we're going to have a quick look at what the overriding customer trends are for the next 5 to 10 years that are going to shape their behaviour and influence opportunities for us. Let's start off with the event that kicked off this last round of the consumer cycle, and of course it's the GFC. Who could forget it? 5 years ago, almost to the day, guys, just a couple of weeks down the track, we'll be celebrating the 5th anniversary of the Lehman Brothers collapse, which is I think the 28th. And look, when you first look at it, some of the headline numbers are not that shocking. For those of us who grew up during the recessions that we had to have, a dip to 1% economic growth is not a terribly shocking thing. A slight uptick in business closures and a slight uptick in unemployment, also not terribly shocking. But for a generation that was, I guess, accustomed to 15 years of robust economic growth and an unshakable faith in the strength of the mining boom and the strong Aussie dollar and the purchasing power that underpinned, to suddenly be faced with a 30% decline in the Aussie dollar and a more than halving of the value of the stock index was a terrible shock. And the oscillations in the market that have followed since have not helped, and they've left the consumer materially worse off in terms of net wealth by around about 12%. And also perceptually really suffering and quite nervous. So what does that look like? Well, customer sentiment has recovered initially after the GFC, just as the market's recovered. But as the market dipped and as the market continued to oscillate, customer sentiment has gradually trended downwards to the point where it's now running at 97. And that's 23 points down on where it was 2 years back. Now, you kind of look at that and you go, all right, well, what's that all about? Because economic growth is not bad, unemployment's not too bad, inflation's under control, and the economists are kind of scratching their heads and going, you know, what an illogical bunch these Australian consumers are. Well, let's not be too quick to judge. Let's try and understand it a little from the customer's perspective. What are they really experiencing? Aside from the shock of the headline numbers, today, they're most definitely suffering some economic stress. On an average household basis, around about 15% of households are suffering some meaningful stress around inability to pay bills, having to borrow money on a short-term basis from family and friends and issues like this. And that's left them saying at a relatively high level that they believe that their family finances are worse today than they were a year ago. The outlook for the economy from a consumer perspective is also not great. They're very worried about the storm clouds on the horizon internationally. On the upside, if you like, much more of a tactical insight, is the sense that many of them see this as not a bad time to buy. Housing prices are down by about 5% from about 2 years ago, and while that's hit them where it hurts in their wealth position, it's also seen as an opportunity for many Aussies who are still looking to get their first home, upgrade, or buy an investment property. Vehicles are also down as a result of a kind of a one-off effect, a change in tariffs a couple of years ago. Cool. What was that song? And also others are looking to buy a major household item. So there is some, if you like, I wouldn't say optimism, but opportunism is probably a better word to use. So generally speaking, people are spending less. And there's been a lot of chat in the press about just what that means to the retail trade. And I love this, these little Urbis charts. Hopefully you can see these blue charts on the left-hand side here that show an oscillation over the last 20 years in retail market growth, both in the food market at the top and the non-food market at the bottom. And this includes online sales, guys. And they're oscillating and trending downwards to the point where overall market growth is supposed to be around about 1 to 2% at the moment. But when you take population effects and CPI out of the equation, we're actually underwater for 2 of the last 3 years. So these markets are going backwards. And this is just plain weird. When you ask consumers, and BCG carried out a study 12 months ago, what their plans were for the year ahead, 48% of Australians said that they plan to cut back on discretionary spend. And that was actually worse than in the US and UK and Europe, where conditions are substantially worse, and equal to Italy, which we're told is a bit of a basket case at the moment. So Australians are quite conservative. They've got quite a conservative mindset as we speak. And just to underline this funny little chart down here on the right-hand side, the purple line that's continually trending downwards is Oz. The pink line that's improving there is the UK, and the yellow line that's bounced back is the US. And this is the overall retail turnover growth in these countries. And again, it's kind of odd, isn't it, that the Australian market, in spite of our robust economy, continues to trend downwards while these other markets are recovering. But that's the way it is. So if they're not spending, what are they doing with their money? Well, clearly, they're saving more. The savings rate has about doubled versus the long-term trend. And it's having an impact not just on their spending, it's having an impact on where they're putting their funds, their investment funds. So equities as a share of overall application disposable income is well down. And the view, this little chart down here in the middle, looking forward, the question there is, what's the wisest place to save? Looking forward, with every quarter that goes by, the jaws open wider and wider in favour of deposits and against equities. And what are they saving for? There's a sort of a relatively critical view of the consumer that's not uncommon in this industry, unfortunately, that says they just don't get it. And the reason these people are saving is because they're timid and they're and maybe they think they're clever and they're trying to time the market. Well, that's certainly true of some consumers, but there's a goodly number of consumers out there that see good returns currently on a risk-adjusted basis in cash and cash equivalents, and they're putting money into cash for good, logical reasons. And there's another group that are wanting to apply their dollars in investment properties. And as you see in the bottom right-hand corner here, while Aussie properties are down by 5%, home loans haven't really moved much at all. LVRs are under quite some pressure. And so if you're going to buy an investment property today, you need a bloody big deposit. So this is another reason why a lot of Aussies are saving. So it's not all illogical, and they're not the nongs that we quite often think that they are. Now, they're also putting less into discretionary super, quite worried about the equity space. They're no longer funneling money in the same quantities, nor are the same number of people contributing money on a personal basis. But as we saw before, the insurance markets are absolutely booming. So what's that all about? Well, those of you who spent some time in behavioural economics will recall that loss aversion is substantially greater than risk attraction, than growth attraction. And that's really what we're seeing here, is that the risk of further loss and the recent memory of the incredible loss that they suffered during the GFC has got folks sort of doubling down on sort of securing their wealth. And we know that there should be plenty more where that came from. They're also seeking to deleverage, but with the incredible level of housing debt, it's quite difficult to do. So they're doing it where they've got the discretion. And you can see the green line here is growth in the personal loans market, which has dipped into the negative over the last 18 to 24 months. And that shows that they're getting their personal debts under control. But the housing debt, which is the blue line, continues to bump along at about 5% growth year on year. And it's really putting a lot of pressure on people's day-to-day finances. You can see the debt to household income ratio here is still bumping along at around about 150, which is close to an all-time high. So people continue to have to deal with very high levels of debt. So faced with that, and faced with declines in the value of their retirement savings, people are beginning to put off retirement. This is not the latest, this is not recent data, it's the latest I could get. Shows that irrespective of age and sex, people are looking at delaying their retirement between 2 and 5 years at the moment. And the greatest spread is in younger and older women who are expecting sort of 4 and 5 year extensions on their retirement. So this is one of the strategies that they're reluctantly expecting to have to adopt. Now going forward, and this is from customer champion work, when asked what would they do, the answer is a bit more of the same. The question was, if you had a windfall gain of 250k, where would you apply that money? And the answer was, I'd reduce my debt, I'd buy an investment property, and I'd put it into cash and cash equivalents. All right, absolutely unequivocally, that's where they want to put their money going forward. So don't expect these trends to change, and they're quite thoughtful. This is not like they don't know. I mean, there was a don't know at the bottom there, 8%. People have got their minds quite well sorted on this issue. And there's certainly some steam left in the insurance boom. 34% of people are saying that they intend to buy more insurance in the next 3 years, and that's probably heartening to you all. But I guess another way of looking at that number, and it's a little bit glass half empty, is that that's nothing like what you would think it should be when you know the level of underinsurance in this market. So there's a really phenomenal educational job that needs to be done there. And then there's an incredible prospecting job. I think that this market, during the superannuation boom, forgot how to reach out, forgot how to sell to customers. And a lot of lifeys were derided for being salespeople. Good salespeople understand their customers. And we shouldn't shy away from that. And we should, I think, be looking to re-inculcate those skills in our planners today, because we're not going to address this underinsurance issue unless we can reach out to prospect amongst customers and convert them and bring them in. When it comes to advice, 62% of the market is open to paying for advice, which I guess is good news, and that's obviously well above the level of customers that are advised. There are about 22% of consumers today reporting themselves as being in an ongoing advice relationship. And it shows that there is a big opportunity there for direct amongst those who are rejectors, but it also shows the 22 versus 62 shows that there's a substantial opportunity amongst the advice acceptors for transactional direct advice. And we should not, this idea of transactional really irritates me because, you know, do you think you're a transactional customer or a mechanic? Does everyone have a mechanic? Right. You happy with your mechanic? Yep. You're going to go back to him? Are you paying your mechanic an ongoing fee? Have you signed a contract with your mechanic? Right. A lot of customers feel the same way about all of their providers. You can have a relationship which is a sausage-linked string of transactions back to back. You don't have to have a signed contract to have a relationship. The customer will see you as their advisor so long as you treat them as if they're your customer. What does that mean? It means being receptive when they call, and it means staying in contact when they don't. When it comes to expectations of investments, people's expectations today are a little bit humbler than they were in the past. Previously, people were worried about comfort prior to retirement, maybe retiring a little early, and certainly having a comfortable retirement. Today, it's switched quite considerably, and people are much more concerned about preservation of lifestyle in retirement than they were previously. Moving away from financial services for the minute, the other big mega kind of driver of consumer behaviour in our space, as all others, is of course the growth in the digital environment, and particularly in online channels. And the story here is, for many of you, probably not a big story, but it bears repeating. And that is that there is no community and no segment and no life stage that's not switched onto the internet today, except for maybe the Mennonites. Okay, there's got to be somebody out there, but Mennonites aside, I reckon everybody's on board. So just to give you some idea of just how pervasive the internet is today, nearly 50% of the grey market are social networking already. Okay, so if you don't have in your sort of plan of things some sort of social networking thinking around how you're going to use social networking to prospect for customers, then you're missing something really, really big here. The number one driver of choice in this market is the opinion of family and friends, and the medium, without a doubt, going forward for seeking that opinion is social media. And while customers aren't currently actively proposing financial advisors through social media, it's 5 minutes away, guys, 5 minutes away. And we've got to get jiggy with that one. Now, this same study that gave us this data had a look at just how active industries were in engaging with customers on the web, And I saw a scary number in there that I just wanted to bring to your attention. The average percentage of players across all industries that took orders online was 51%. In the wealth market, it was the lowest at 18%. Only 18% of players in the wealth market take orders online, and it was a half the next lowest. Okay? So that is a gap that's wide enough for the specialist direct players to drive a truck through. If the wealth players don't get on top of it and close that gap quickly, they will lose that opportunity to talk to those new customers. They're coming into the market and they take a transactional approach for their very first engagement in wealth. It's really, really critical, and it's time to get moving. So enough of these kind of, if you like, the sort of general data-driven views of how people's behaviour has been shaped by the GFC. Let's talk a little bit about behavioural trends that are going to shape all consumer behaviour going forward for the next 5 to 10 years. Some of these are a little esoteric. You know, we could talk for days on marketers' views of what are trends and what are not. What I've tried to do is I've tried to chunk it down to just a few trends that are really big and that ought to have some implications very specifically for wealth. So let's start with the first one, and I think today it's really interesting to be talking about this with the super trawler legislation making headlines. In less than 2 weeks, GetUp got a campaign going against this super trawler, took it to headline news. It's actually being carried around the world at the moment, believe it or not, and achieved breakthrough legislation that stopped that super trawler. Whether it's right, wrong or indifferent, I'm not here to talk about, but it's amazing how powerful social media has made articulate agitators, activists, people with a bona fide issue. And that same power, if we're not careful, while we can leverage it through social media engagement, can be turned against us if we don't move on errors we make or poor practice in our industry. So the kinds of things that you're here to talk about today, I think are spot on. Because I've got to tell you, if we don't move on improved transparency and appropriate engagement with the customer, you know, the resistance will turn into an issue that eventually will find its way into the social media and will have the kind of news that we don't want to have to deal with. Cloud computing is definitely the IT trend for the next 5 or 10 years. And you know, maybe that's not massive news, but it's quite impressive the amount of investment that's going to be required to respond to that in the wealth space. People see our information that we hold on them and their transactions as their information, and they expect to have access to it anytime, any place. And guys, they're pretty much already getting that from the banks and the telcos. And what they're not currently getting, they'll have within about 6 months, because they're all spending enormously to be able to make that available. And I've got to tell you, the difference between a bank, a telco and an insurance company from the consumer's perspective, it ain't great. Their expectation is we'll be providing the same thing very shortly. And I know, based on the legacy system structures that most institutions have in Australia and the difficulties advisors have in extracting information on their clients' holdings and performance, that this is a really big challenge. But I've got to tell you, until it's addressed, we're going to start seeing within about 6 to 12 months a level of comment and dissatisfaction around us not being able to make that available. Active greys. Baby boomers are starting to get grey around the temples, and they don't age like other people. They're taking their active lifestyle and their engaged sort of feisty attitude to life into the third age, and expect to see much more active, you know, what we would regard as retirement phases from these guys. Much more likely to continue working through that third age. Much more likely to want to grow and travel and continue to adventure as they have throughout the rest of their lives. And this has very profound implications for retirement planning, because it ain't cheap, it ain't cheap, and cash flow is going to be very important. The new normal. Unfortunately, there is a growing base in our society that's bigger with every year that goes by, and the GFC's only served to increase that. But there are companies out there that are finding ways to serve these needs that are just as valid as any other needs in society. And we'll see that happening in wealth, just as we've seen Aldi stepping into the supermarket space and take the service proposition back 30 years but they're serving a need that the big two have not been able to serve, and they are absolutely booming. So expect to see the same sort of thing happen in our space. And we've had access to these customers through the bank channel for many years, but shame on us, we haven't done anything with it. We need to move quickly because the direct players are on this already. Funeral cover and other sort of, if you like, not loss leaders, but other lead products that are building a relationship that will enable them to build scale businesses around this franchise. Live a little. People are sick of austerity. They understand that there is going to be some ongoing need to keep the dollars under control. But they need to program, and they're choosing to program into their lives little rewards along the way, little moments of luxury, little moments of indulgence. And from a planning perspective, it's really critical that we make sure that our customers are not getting themselves into this bind where there's no relief valve and they're just running for 30 years until retirement, at which point there'd be little point having much money if they're almost dead. And maybe there's a sort of thought that maybe we shouldn't be just looking at retirement goals, we should be looking at living goals in between now and retirement, that's just as valid and it's important to have the two balanced. Augmented reality. Who's been to Investorville? Anybody been to Investorville? Okay, you got to go. Investorville's a property investment simulator that the CBA has put together, and it is spectacular. All right? And it's just one example of how marketers are using smartphones and tablet devices to create alternate realities as a means of demonstrating the benefits of their sell, of giving customers the opportunity to explore options and learn. And it is beautiful, this thing, and it's been phenomenally successful. I was just on the panel for a major marketing award, and we gave an effectiveness award to this tiny little thing. It only cost a couple of $100,000, and it beat these massive multi-million-dollar campaigns because the impact it had on the bottom line for these people was just outstanding. Now, what goes for investment property goes doubly and triply for wealth. If investment property can be dimensionalised and sold more effectively using these kinds of mediums, just imagine what we can do with wealth. Well beyond what those silly retirement calculators that we so love enable customers to do. We can make this such an enriching experience. And if you want to find a way to demonstrate underinsurance, what a fantastic medium for doing it. Now, time's tight, so I'm going to crunch through the last 6 trends, just ticking them off very quickly because I think they're reasonably self-explanatory. Social profiling. There are lots of shrewd, data-driven folks out there watching everything that happens in social media, and it shapes the power. What you do in social media shapes your influence in social media. So the more influential you are, the more people are going to seek you out, and the more opening you will have. The less influential you are, the less likely you are to even appear on the screen when people have got 1,000, tweets to look at, right? So in the future, today and tomorrow, if advisors do need to use social media to reach out to their customers, they're going to have to look to building a social profile such that they can be effective, and the right social profile so that they're effective with the group they're pursuing. Collaboration, it's self-explanatory. Investors are looking for it, and maybe a bit more coaching in the relationship rather than the delegator entirely. Simple comforts. When you can't afford the luxuries in life, you find a way to take pleasures in the simple comforts of life. Look at MasterChef. Where the heck did that come from? Why is it so big? People love home cooking. They're into gardening. They're into home movies. They're into the regular holiday up and down the coast again. People are finding joys in the simple pleasures. And I'm not sure exactly what the implication is there, but it's something that's such a big and important part of our life today and will be for the next 5 or 10 years. It just seems important to mention. See that guy with the cheesy looking grin there? The reason he's smiling is because he just sold his business to Zuckerberg for $1 billion. He's only 28. All right? Now he's done what a lot of people of his generation are doing, who just couldn't get a job when they left university or were offered MIC jobs that were really, really unrewarding. And they've decided to go it alone. There is a huge cohort of young people in their late teens to to early and mid-20s who are out there building their own businesses, leveraging their digital skills. And they are very different to the young people we've dealt with in the past. But like all young people, when they come to advice, they're not that confident about their financial knowledge, They don't want some geezer sitting across the table from them. They're worried that he's going to patronise them and look down on them like Dad does. They want somebody who looks like them, who they can empathise with, and who maybe will connect with them in the digital forums that they would think is appropriate. Classic objects. The more the world becomes digitised, the more people hanker after the tangible, the physical, the texture of holding something real in their hands. And there's this fetishism around classics, LP records, old cars without power steering and with gearboxes, for goodness sakes. Yeah? And no electric engine in the back or front or wherever they put that stupid thing. So expect that this will only continue, and the more we get into these sort of enhanced reality scenarios and things, the more people are going to want to have something solid to hold on to. And so what does that mean for us? I don't know, maybe collectibles as an investment class are going to have another bounce again. But it's important to consumers, and so it's something that we should be aware of. Oh, and, you know, very self-serving one at the bottom. Ever since our friend Seinfeld, it's been acceptable for adults to be into superheroes, and that's a trend that only continues. Good for me. So, just in summary, where are we at, and what does it mean for us? Well, look, where we're at is that customers' wealth is down meaningfully as a ratio to their disposable income. They are suffering real stress. They will continue to keep their spending under control and keep their saving up. And the implications for us are that we need to meet the customer where they're at. We need to listen to the economists, but we need to not listen to the economists bitching about the consumer and how stupid they are. And we need to not listen to the old hacks in the industry who say the consumer's stupid as well. A lot of what they're doing for good reason. Their perception is our reality. We need to meet them at their perception and serve those needs. Insurance, it's a great opportunity, but we need to get out there and we need to prospect. This idea of delaying retirement, maybe if we found a way to engage with them earlier, they'd have more options. This idea of direct, guys, watch the direct specialists. Don't let them cut our lunch. They're already out there. One of them spending over $10 million a year on year for the last 3 or 4 years on building a consumer franchise. We might laugh at the products, you know, funeral insurance and all that stuff. They're laughing all the way to the bank. One of them's raising money through private equity concerns, and these guys are not stupid. They're not going to give them increasing media spend unless they're seeing a return on the bottom line already. The trends, well, I'd encourage you to think about them broadly. Think about them and how they might shape the way you target customers, who you go after. Think about them and how they might shape the way you prospect and find customers and convert them. Think about them in terms of how they might shape the strategy you present to your customers and the service offering you have during the relationship. So hopefully, guys, that's given you a little bit of context on where the consumer is at today, and a general sort of background and customer platform for the panel discussion. Thanks for your time.